The role of hedging in reducing interest rate risk in banking book. In the world of banking, interest rate risk is a constant concern. Fluctuations in interest rates can have a significant impact on a bank's profitability and overall financial health. One way that banks can mitigate this risk is through hedging strategies. Understanding interest rate risk. Before we delve into hedging, let's first understand interest rate risk. Interest rate risk refers to the potential for changes in interest rates to negatively impact a bank's net interest margin. When interest rates rise, banks with a large portfolio of fixed-rate assets may face challenges as their funding costs increase, while the income from their assets remains fixed. On the other hand, falling interest rates can reduce a bank's profitability as the income from their floating-rate assets decreases. Hedging as a risk management tool. Hedging is a risk management tool used by banks to offset potential losses from adverse movements in interest rates. A bank can enter into derivative contracts, such as interest rate swaps or options, to protect itself against adverse interest rate movements. These derivative contracts allow banks to customize their exposure to interest rate risk based on their specific needs and risk appetite. Interest rate swaps. Interest rate swaps are commonly used by banks for hedging purposes. In a swap, two parties agree to exchange payments based on a predetermined interest rate. For example, a bank may enter into an interest rate swap where it agrees to receive a fixed interest rate payment and, in exchange, pays a floating interest rate payment. This allows the bank to hedge against the risk of rising interest rates by locking in a fixed rate. Options as hedging instruments. Another hedging instrument used by banks is options. Options provide the buyer with the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a specific time frame. Banks can use interest rate options, such as interest rate caps or floors, to mitigate the impact of interest rate fluctuations. For instance, a bank may purchase an interest rate cap to protect against an increase in interest rates beyond a certain level. If rates rise, the bank receives compensation from the cap that offsets their increased borrowing costs. Benefits of hedging interest rate risk. Hedging interest rate risk provides several benefits for banks. Firstly, it helps stabilize a bank's net interest margin by protecting against interest rate movements that could negatively impact revenue. Secondly, it enhances the predictability of a bank's cash flows, allowing for better financial planning and risk management. Additionally, hedging can increase a bank's competitive advantage by enabling them to offer customers more stable and predictable rates on financial products. Risks and considerations. While hedging can be an effective risk management tool, it's essential for banks to carefully consider the costs and complexities associated with implementing hedging strategies. Hedging requires expertise in derivatives and risk management, as well as an understanding of regulatory requirements. Banks must also monitor their hedging positions regularly to ensure they remain aligned with their risk management objectives. In conclusion, hedging plays a vital role in reducing interest rate risk in a bank's book. It offers protection against adverse interest rate movements, stabilizes revenue, enhances cash flow predictability, and gives banks a competitive edge. However, banks must carefully assess the costs, complexities, and regulatory implications associated with hedging to ensure its effective implementation. Want to learn more? Claire Trithel on LinkedIn.